Welcome to This Week in Money. I'm Jim Goddard. Today, Rick Rule from Sprott Global Resource Investments calls gold catastrophe insurance. John Kaiser of Kaiser Research explains how the big banks plan to bleed you dry. And KC Research's Louis James sees exciting times ahead for Palladium. We talk to Rick Rule right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Rick Rule, founder and chairman of Sprott Global Resources Investments, and he's also the publisher of the Gold Report, although we call it the O Report. Rick, welcome to the show.
Thank you. Nice to be on it.
Well, gold again is now going up, but is this a continuing trend or just a little blip, and will we see it take another major dive like it did last summer?
Well, I think somewhere between the two. I think that gold has bottomed, and I think gold is headed higher. But gold needs to consolidate its gains. The nature of bull markets is that they're not straight up. The nature of bear markets is they're not straight down. I would expect that we're going to be in a rising channel for gold with higher highs and higher lows. But certainly the volatility that we've experienced in the last while will be with us for a while. Your listeners that don't have long memories might need to be informed that the 1970 to 1981 gold bull market, the epic market when it went from $35 to $850 an ounce, had 11 or 12 periods of greater than 20% decline, cyclical declines in secular bull markets. But a 20% decline, if you don't have the cash or the courage to stay your trade, is certainly a religious experience. So yes, it's going higher, and yes, keep your seatbelts fastened.
Yeah, well, it seems that's been the ride that we've been on the short little while. We start to be optimistic, and it seems to happen to every market where it looks like it's taking off like a homesick angel, and the next thing you know, it's a submarine with screen doors.
Yep, that's absolutely right.
Do you have to be a much sharper trader, more acute person than ever right now?
I don't think that it pays to be a trader particularly. I think that traders in a market like this get whipsawed. People who are too aggressive and too cute miss the point. The point is that gold, relative to its primary alternative, the U.S. 10-year Treasury, is a much better buy over the 2 or 3 or 4 year time frame in terms of maintaining your purchasing power. If you are the sort of person who looks at an asset from a short-term trading point of view, gold is not for you unless you're a professional trader. Remember that what gold is a medium of exchange, like a money, that's simultaneously a store of value. It represents catastrophe insurance. You buy gold because you want to maintain your purchasing power over 10 years. What you need to do in that context is if gold falls from $1,300 to $1,150, buy more. If gold goes from $1,150 to $1,300 and you're a trader, sell some. Mostly, I think, traders with regards to gold miss the point.
David Smith, one of the analysts for the Morgan Report, likens gold to flour in your store. He said, there's nothing wrong with this flour. It usually sells for 5 cents a bag, or I should say $5 a bag, but now it's down to $2.50. Does that mean that flour is bad, or is it just a bargain? He says, well, he believes gold is the same thing. When the price goes down, is it still the same gold it was when it was really pricey? Of course it is.
And of course, substantially better than flour, or currency, from that point of view. It doesn't get weevils. The nature of gold is that it's been with us for 2,000 or 3,000 or 4,000 years, depending on the cultures that you come from. And it's very, very, very important to recognize that. And his point is very well taken. The move in gold from 1,900 down to 1,100, while it may have been unnerving, has precedence. In that same gold bull market that we talked about in the decade of the 70s, in 1975, the gold price had run from $35 an ounce to $200 an ounce. And at the end of that year, it absolutely collapsed from $200 to $100 an ounce. A 50% cyclical decline in a secular bull market. People who got shaken out in the context of that missed a move from early 1976 to 1981 of 850%, from $100 an ounce to $850 an ounce in 5 short years. There's lessons there.
Are you going to be going to the Prospector Development Association of Canada conference in Toronto next week?
I'm delighted to say I will for my 20-something year.
I know John Kaiser is worried that the same thing's going to happen this year as happened in most other years. Everybody gets together, they chat, and then resource prices go down. And he just doesn't want to see that happen again. Do you think it will go down?
Well, John has a very different point of view and a very different set of needs. In the Sprott organization, we have maybe a somewhat longer time horizon to John. We also have an awful lot of cash to invest as a consequence of some recently won overseas mandates. We would welcome lower prices. The nature of buying low and selling high involves, of course, buying low. And periods in time when the markets are off 75% are very good times for buying. We've seen a run-up in the price of junior equities beginning in October of last year, which has made the deployment of capital, particularly the deployment of capital in private transactions with warrants, somewhat more difficult. So we would welcome a cooling of the current trend that we see. And my suspicion is that we'll get it. The TSXV as a whole is up, 16%? And probably 60% of the issues on the TSXV have no net present value. The better issues on the exchange are up by 35 or 40%, and we would welcome a cooling trend, which we, by the way, think is inevitable.
A lot of junior companies went under or had to merge in the past year. Is that an opportunity for buyers?
Well, nowhere near enough. If you look back in the 1991 to 1993 bear market, the predecessor to the TSXV, the VSE, probably lost 35% of its resource issuers. That was a proper cleansing. And those of your readers and listeners who were there for that, remember that when the diamond discoveries kicked up the market in 1993, there was literally a shortage of vehicles to buy. When the money came back into that market after that wonderful purging, there was the most violent recovery that I have ever seen. And we are in a market right now that needs to purge much, much, much further than it is done. I fear that won't take place, but I pray it does.
What happens to all the failures? Is that just nature taking its proper course?
Yes, of course. They go to money heaven. The sins of the 2003 to 2011 bull market were legend. Way too much money came out of the sector in general and administrative expenses, lawyers' fees, commissions, legal fees. There were way too many Me Too vehicles. The industry got way, way, way overheated. And the cost of capital, or put a different way, the return on capital from the point of view of the investors, got worse and worse and worse. And these are all excesses that need to be exorcised from the system.
Well, once they're out of the system, how healthy will it be?
Well, my experience has been that bear markets are the authors of bull markets, and that the recovery is, in fact, a mirror of the decline. And by that measure, this recovery should be spectacular indeed. The viciousness of this decline, beginning in early 2011 to its bottom in the middle of 2013, was certainly as sudden and as vicious as any I remember. A 75% decline in 2.5 years is vicious by any measure. My suspicion is that the beginning of the recovery will be somewhat tepid because there's a lot of sin still to wash out of the system. But I suspect that the strength of the recovery 18 months or so from now, when it gets going, will pleasantly surprise even the most optimistic of forecasters.
And then, what takes place, but in between then and now, what's going to happen?
Then and now you're in a stock picker's market. Higher highs, higher lows, but plenty of volatility, plenty of chances to lose money. People who buy this sector get massacred. You need to realize that the junior sector is perpetually overvalued because most players in the sectors have no value whatsoever. That disguises the fact that the performance of the best players in the sector generates so much performance that they add credibility and occasionally luster to the whole sector. And so it's a case of not being in the junior resource market. It's a case of using the junior resource market to find the very, very, very best issuers. To the extent you do that, you can do extremely well.
How do you find those best producers?
Well, it's fairly simple. It involves really using common sense. I think that you start with the management team, and you look at a management team that has been successful before, but importantly, you look at a team that has been successful at a task that very, very, very closely resembles the task that they've set out for themselves. If their success, as an example, has been associated with producing gold in French-speaking Quebec, but the task that they're assigned in this company is exploring for gold in Spanish-speaking Peru, the experience that they have is not particularly relevant, and they should be excused. You shouldn't pay attention to that. Moving on from there, you want materiality. Too often, people in the exploration business look for small mines. And a very bad thing can happen. They can be successful, because everything that can go wrong with a big mine can go wrong with a small mine. But a small mine can never make you big money. So the business plan has to involve materiality. The next thing is that value is added in exploration or development by answering a series of unanswered questions. The investor needs to know the management's plan with regards to unanswered questions. If the management doesn't have a plan, they're planning to fail. And it's important that the investor look at the plan in the context of the assumptions behind it and whether or not the thesis has been ground truthed, and then look at the proposal to test the plan in the same light. The third question that investors should ask is, how much money does it take? How much time will it take? Does the company have the money to answer the plan? Because if they don't have the money to answer the plan, you presuppose a no answer, which means it's going to zero. Common sense, but 80% of the participants in the market don't do it. Mostly, the investor's plan is, got a hunch, bet a bunch.
And that, of course, it will probably lose you a bunch at the same time.
Absolutely, guaranteed.
How do you know the advice you're getting in what to invest in is good?
Well, one of the things that I like to do is I like to ask the person who is giving me advice or telling me a story about a company a question where I know the answer and see if they lie to me. That makes it very simple. You don't have to talk to that person anymore. And you can keep moving on. The second thing is truth all your answers. If you say to a company, what level of general and administrative expenditures do you anticipate having over the next 10 years? Or, pardon me, over the next 2 years. If they give you a number, backtest it against the last few quarters. If they've told you that they're spending $40,000 a month in G&A, and it turns out last year they spent $1.8 million, there's two choices. Either they're stupid or they're liars. Neither of those are good choices.
When you sort out the liars from the ones telling the truth, how many out there do you say are really truthful? I mean, I've heard some companies keep 27 different kinds of books depending on who they're talking to.
You know, you can reasonably rely on the quarterly filing statements that the companies are forced to put on CDAR. Yes, occasionally people will file fraudulent financials, but the probability that somebody that you're dealing with is filing a fraudulent financial and the chances that it got through the auditors in particular are very, very, very low. The simple fact is that not 10 investors out of 100 pay attention enough to even read the financials, particularly the notes to the financials.
All of us, on our podcast say, we're not giving people advice on what to buy. Please, do your homework. We're not your investment counselor. And yet, how many do you think will run off and say, I heard something on the TV, the radio, read it in the paper, and boy, I'm going to just jump right on that before I lose my opportunity?
Yeah, silly. It's really, truly silly. It's odd, particularly with regards to financial assets, the impact of a bull market. The fact that the market was off 75% by the end of summer last year made the market precisely 75% more attractive. It's very strange that if a rational person went out to shop for some groceries or a shirt and they accounted a 75% off sale, they'd be elated. But you see a market that's off by 75%, which is to say 75% cheaper, or a 75% off sale, and people are repulsed. Now, isn't that odd? I mean, suppose one of your listeners in Vancouver was looking for a Lexus, a nice car. And I don't know what a Lexus costs in Vancouver. But let's say it costs $100,000. They go to the Lexus dealer, they drive it, they kind of like it, but they're nervous about $100,000 for a car. And they go back 2 years later. The same car, brand new, sits on the lot for $25,000. I mean, who wouldn't be happy about that? That's precisely what happened on the TSXV, and people were horrified as opposed to happy. Strange set of circumstances, isn't it?
I think it's, I call it sheep mentality, crowd mentality, where, geez, the guy across the street is doing it, I better do it too.
Right. I got it.
So beyond that, if you've done your research and so on, do we have a good market for people to look at?
I think we have a great market to look at if people's expectations are rational. I think we have a truly spectacular market to look at if people are disciplined and their expectations are rational.
But trying to make a zillion overnight is probably a fool's dream.
You know, when I'm at these conferences and somebody says, you know, what do you have that's going to triple in 3 months? And the only answer I can ever think of is your debit balance, sir.
Good answer. Rick, is there a website or a number of websites people could go to take a look at some of your discoveries and what you've dug up for us?
Absolutely. If you come to the Sprott USA website, which is www.sprottglobal.com, in particular, what I would urge your listeners and readers to do is to look on that homepage for Sprott's Thoughts and click on subscribe. I guarantee you'll get your money's worth because it's absolutely free. 3 times a week, the best minds in the Sprott organization, including, of course, Eric Sprott, John Embry, Dr. Mark Faber, and myself, but also including many other analysts and portfolio managers, comment on the markets, giving the best ideas, the best opinions, the best paradigm that's contained within the whole Sprott organization. It's yours 3 times a week in your inbox, absolutely free, simply by clicking on subscribe.
Coming up, John Kaiser on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is John Kaiser of KaiserResearch.com. You can also find him by going to Kaiser Research Online. Either one works. Thanks a lot for being with us, John.
Jim, it's great to be here.
Next week, we have the Prospector Development Association of Canada Conference in Toronto. And that's where all the big wigs in the development business get together, discuss what's going to happen. And you're hoping that we have a trend change from that development conference. Tell us why you'd like to see a change.
Well, it has become this perverse phenomenon. We call it the PDAC curse, that shortly after this major conference in Toronto, where the mining industry from around the world gets together and celebrates its existence, the resource sector enters a downturn. And this downtrend has only not happened in a few years, such as 2006 and 2009. And of course, the last 3 years that we have been pretty much in relentless downturns throughout the years. And so we're hoping that this year maybe we can navigate through March and continue this selective resource bull market that began at the end of 2013.
Why do you think this happens?
You know, there's an old adage that says, sell in May and go away. You know, the summer doldrums are coming and all that. So all the action happens in the first sort of 4 or 5 months of the year. And of course, whenever a technical pattern becomes very obvious, the market starts to undermine it by second guessing it and anticipating it. And so we've seen this sort of drift earlier and earlier into the year, where the people say, okay, I'm not going to be the one left holding the bag, so I'm going to sell now. And then every once in a while there's a bit of a reset, and just the mechanical following of it gets reversed. And in 2006, it was the mining companies realizing we have to stop forward selling copper and all these metals at low prices because something is happening big in China. And in 2009, it was the QE1 that kicked in and said, oh, the world is not ending, and we blazed right through the PDAC curse in those 2 years.
Well, that was a good time then, but do you think we can turn it around this year?
Well, what's I think been driving the turnaround that seems to be underway is gold's ability to climb above $1,300 and hold itself there, despite the continuing taper that's in effect. The American economy is supposedly improving. Gold has, of course, been helped because money is being pulled from the emerging markets, and people in those parts of the world have been rushing into gold because they can see their own currency collapsing, and they may not be so keen to hold U.S. dollars. So if gold can hold itself above $1,300 and build a base between $1,300 and $1,500, we have the foundations for recovery, because the general sentiment at the end of last year was that we're going to see gold perhaps even below $1,100, and then in that case the gold sector is pretty much dead in the water.
What about other natural resources?
Well, there's many of the metals such as copper are expected to be in surplus for the next few years. Nickel is in surplus because in the Philippines and in Indonesia, this new type of nickel pig iron created in China using cheap laterite ores has flooded the world with nickel surplus, and the big conventional producers have not cut back because they think this can't last. So nickel has been in the doghouse. The one metal that I think is going to do well is zinc, and that's for a couple reasons. One, Western mines are shutting down, and what's coming on stream is not as much as what's shutting down. And two, the wild card that people aren't thinking about is that China, which has doubled its output in the last decade, may actually go in reverse with its output for a couple reasons. One is the crackdown that's coming on polluting mines. Another is that the Chinese shadow banking system, which has bankrolled many of these small operations, is starting to pull in its loans, which will help shut down many of these operations. And the third is the low-hanging fruit that these small mines have been harvesting must be heading towards depletion. So we could get a double whammy of supply shortfalls, even as demand for zinc is rising, which could finally get zinc out of its doghouse where it's been for the last 5 years.
Well, zinc is in every battery, and now that electric cars are now coming to the forefront, they're going to need a lot of zinc.
Yes, and even China's shift towards a domestic economy, which is essential for it to sustain any sort of decent growth, that will also be zinc intensive. Zinc is used both for consumer articles as well as infrastructure build out, which is not necessarily the case with metals like iron, where it tends to be more infrastructure build out related.
If you were going to invest in a junior mining company, how could you go forward and make sure they're going to be okay? Because I've been told it's been a slaughterhouse out there with commodity prices dropping. A lot of junior miners didn't have the reserves to carry on. Are we going to see more failures, or have we seen pretty well the slaughter take place and the survivors are relatively strong?
Yeah, last year has been a major purge amongst the producers, shutting down projects that were under development, that had giant cost blowouts, ones that didn't work at $1,200 gold. So a lot of these projects have been written off, shut down, and are not going to be causing any negative cash flow for the next while. So the industry has been in a consolidation period. We'll get all the ugly earnings reports in the first half of this year, and then that will be behind us, and people will be focusing on the cash flow that's being produced by the remaining operations. And the assumption is, okay, the metal prices have stabilized where they are. If the company can clean up its operations so that they're cash flow positive now, then if we do get a strengthening of the global economy, then, well, that's going to be all gravy, and then we'll get a solid uptrend. But right now, they're focusing on, pushing higher those companies which are in best shape with the current metal prices that we do have, and this anticipation of higher metal prices is still pretty much absent from the thought process of investors in the resource sector.
Because of the slaughter, as I said, in the junior mining business, what about their ability to raise funds right now? Are people being scared away?
Well, what was interesting is from about middle of January on, when the market realized that there is a turnaround underway and gold Corp made its $2.5 billion bid for Osisko, the Bay Street guys realized we're going to lose all these advanced companies which are going to be bought out at modest markups from rock bottom prices by various predatory entities, private equity, and so on. So we saw about $700 to $800 billion worth of worth of bought deals announced in the last 6 weeks, mainly involving more advanced gold projects. But for the smaller companies and earlier stage companies, it is still a miserable situation, and the regulators are still going full tilt with their agenda of destroying the ability of junior companies to raise risk capital from investors.
I was just going to ask about the Canadian Stock Exchange versus the Toronto Venture Exchange, and how companies might be looking for the best deal there. Do they have any hope that perhaps the regulations will be cut back and they'll be more encouraging for these small companies?
Well, the commission's on January 20th, the comment period ended for a proposal to allow retail investors who don't meet the $1 million accredited investor definition to do on a limited basis private placements in companies. And we have not yet seen the comments published and where that is going, but we have seen the regulators wanting to tighten even the accredited investor requirements, which would make it very difficult for companies even to get money from people who are technically classified as millionaires. I think it is critical that they loosen up the ability of investors to put money directly into the treasuries of the juniors, especially if we want discovery exploration to happen. The bigger, more advanced type of projects, the ones that are raising the $20, $30 million bought deals, that is institutional capital that goes into those. But the bulk of the venture exchange are earlier stage companies who do not need to raise $10, $20 million in one shot. They need $500,000, million, $1 million, $2 million, maybe $5 million, all of which is beneath the bother of the brokerage firms. And so these companies need to be able to go directly to investors and get the money outside of the brokerage industry.
Isn't it these leading edge little companies that usually find, perhaps the edge or even the middle of resource areas that we didn't know about? Aren't these little guys really important to make sure we have bigger discoveries down the line?
Yes, the story of the past decade was all the failures of past exploration cycles. Deposits where the grade quite wasn't good enough to be put into production during the 60s, 70s, 80s, and 90s. All of a sudden, when we had higher real prices, these were dragged out of the woodwork, and they went to work demonstrating that they are, in fact, feasible. And this has now been done, and we've been through this cycle. But if metal prices are now going to be flat or rising only modestly in real terms for the next 5 to 10 years, then if you want more material, more raw material, you are going to have to find brand new deposits that have a grade and size good enough to work with the metal prices that we have. And because we have had, 100 years of intensive exploration, this requires much greater creativity. It requires looking under cover of either gravels or barren rock and generating high-risk targets that you don't just bang an outcrop and say, wow, we got gold here, let's put a drill on it and just delineate it. Now you actually have to generate blind targets and then test them. And that is quite capital intensive, and the system is not geared to fund that type of high-risk venture anymore.
What do you think is going to happen in the long run if we don't stop this drive? And I don't understand why the drive for more regulation is going on, because in most other sectors, people have been trying to, cut back on regulation so the flow of money is a lot easier. Why would they try to restrict it?
There is a grand agenda in Canada to turn this into a rocking chair nation where people are no longer responsible for any investment decisions. The banks want you to give them your money, and then they'll bleed it at 2% a year, and they'll park it in these various structured products, all based on an algorithm which crunches your profile in terms of what your health is and all this kind of stuff. And they want to turn you into those little cells that we had in the matrix where you are nothing but a source of electricity or fuel for the system. And anything that's a sort of a venture capital risk type situation where an individual could make an awful lot of money, that is anathema to them, because the kind of money you're going to be making parked in their so-called balanced portfolio is going to be not very much. And it's all being done in the name of protecting the investor from losses and so on.
Well, the big loss there is going to be inflation, because the government doesn't give us the real inflation numbers. If you take away fuel and housing, which are probably our biggest expenses, we do not run at 2% inflation a year. We're running at between 5 and 9. You would starve to death if you stayed on a 2% a year improvement.
Well, no, this is it. Well, if the rates of return remain low like that, this is an issue. But the 2% I was referring to is what the banks are going to take on the value of your portfolio, whether it is up or down. They're going to make money from you, no matter what the market trend is, whether we're in a bear market going down or in a bull market going up. And so they're turning the people into just these, sources of income for them. It's a heads I win, tails you lose type of situation.
Just like the Royal Bank doubling service fees last June.
Yes, and then they come up with these structured products where they have all these hidden internal fees because they manage these structured products. And the sad thing is, Canada's role as a resource sector entrepreneurial country, this is going to go down the toilet. And the Australians will continue to do it. Other countries will continue to do it around the world. But this institution of the Canadian explorer finding stuff all over the world, this is just going to wither away and disappear.
That is such a sad thing to hear, John, and I hope it doesn't happen, but unless, I guess, investors and the rest of Canada stands up, the government's going to allow the banks to do that.
Yeah, they're going to just lull everybody, strap them into rocking chairs, and then rock them slowly to death from sheer boredom.
Or sheer lack of money and starvation.
Well, the whole purpose of it is to provide you with just enough income to survive.
Please remind people what websites they could go to again take a look at some of the items you can find from Kaiser Research.
It's kaiserresearch.com.
After the break, Louis James on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Louis James, metals and mining strategist at KC Research. Welcome to the show, Louis.
Glad to be here.
Well, today we're going to take a look at the big turnaround in gold and silver, and perhaps what might happen to the future of a market that's looking pretty promising right now. Well, gold and silver last June, the big dump where over one weekend we saw hundreds and hundreds of dollars taken off the table per ounce. Now it's getting back to what some people would say is normal, but is this normal right now?
Actually, I'd say we're still below normal. I think there's a couple things people need to keep in mind, and that is that as gold took its step downs last year, most of that was based on rumor. It was the possibility that the Fed might be considering thinking about maybe tapering. And when these headlines came out, gold got whacked. But note that when the Fed actually did taper, gold actually held on. It tapered twice, and gold did not get whacked. To me, this tells us something very important, that most of the fair weather friends of gold, as it were, they liquidated early. They were already out. And the people who wanted to sell have sold. So now things are turning around, and it's important to remember that. Remember why gold got whacked and what happened when the reality actually materialized. And I think that gives us more confidence going forward, that it's not just a fluctuation, it's not just, a little bull rally on a larger bear slide. No. Gold got hit. It got hit too hard. It got undervalued by a number of different valuation systems, and now that reality is sinking in, plus the physical buying from the East, which is also well discussed in the media, pushing everything in the right direction.
China last year snapped up all the physical gold they could lay their hands on. I hear this year they have started to import gold because even though they are the world's largest gold producer, they can't make enough for themselves.
That's correct. The Chinese production isn't exported. It stays in the country. But they're still, they've been importing for some time, but those imports are going through the roof. If you look at a chart of the Chinese gold imports through Hong Kong, they're just going vertical. And that's on top of the gold production, which, as you know, China is now a bigger gold producer than South Africa, which lost its crown a little while back. So it's a huge amount of consumption there, and it's taking physical gold off the hands of sellers in the West, moving it to the East. And that's fundamentally bearish for gold.
Well, I'm wondering what would happen if somebody took their gold certificate right now and said, give me all that gold right now. Germany asked for their gold back from the States, and they've been told, what, it's going to take a decade to get it back?
You've taken the words right out of my mouth. Yes, Germany just did that and was told that, sorry, it'll take 7 years. And so far, a year later, they've only gotten, 5 of their, I forget the larger number of their tons, but they've gotten 6, and there's no real explanation forthcoming, but obviously there are legitimate questions as to how much gold supposedly in these storehouses, these government storehouses, are actually there.
And my question always was, is there really any gold in Fort Knox anymore?
Yes. Well, nobody will know. They won't give us permission to audit it. But at the end of the day, it in a way, that it doesn't really matter. If it's there, it's going to stay there. If it's not there, it's going to stay not there. The fundamental reality of the gold market is much larger than that.
And what is the fundamental reality?
That gold is money. And most people still don't get this. I mean, we had all these mainstream bankers making their projections for gold for 2014, and they were projecting it was going to continue down. You know, the generous ones were giving gold $1,050 as a target price by the end of 2014, and a number of these guys are having to retract their projections and change things around because they just don't get it. They think of gold as a commodity like pork bellies or coffee or something. They don't understand that gold is money, and it is the best hedge against all this crazy money printing that governments are doing all around the world by the trillions of currency units. And as my boss, Casey, likes to say, gold is the only financial asset that is not simultaneously somebody else's liability. You hold it in your hand, it has value. At whatever price, you can trade it with somebody else for something.
Even if it's just food.
Even if it's just food in a Mad Max scenario, that's correct.
And, of course, when you talk about currency, Bitcoin has turned out to be the dangerous little ornament that people have told us it would be or could be. It started off at 10 cents, goes to more than the price of gold, and now it's about the same as 10 cups of coffee at Starbucks.
Yeah, I don't have to, but if you'll permit me, I will pat myself a little bit on the back here. I actually issued a sell recommendation in the December issue of the International Speculator when Bitcoin was higher than gold. And I said, look, guys, this is silly. I mean, it's a great idea. We're fans of digital currency. But there's no way something that's backed by nothing can be worth more than an ounce of gold in your hand. And Bitcoin was not a recommendation in our portfolio, so I can't track the gain. But that was just about top-ticking the market. I can't say that I knew it would happen, but it was just one of those situations where it's so obvious when something that is literally nothing but a proof of logic in a computer network is being valued for more than something solid that you can feel the weight of it in. You know, everybody in the world recognizes it and values it. It was a no-brainer. And as far as the technical reasons about, you know, weaknesses with the system and so on, we don't need to get into all that. I would still tell people that we like digital currencies, but we like them if they're backed with something, not if they're backed by nothing but an idea.
More with Louis James next on This Week in Money.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Louis James, metals and mining strategist at Casey Research. Well, going forward now, Louis, what do we think is going to happen to gold and other metals? I think right now you told me we should be able, or we should really be trying to distinguish the difference between precious metals and base metals.
Yes, I do think that's important because they really are different. As we were just discussing before the break, gold is money. It is also a commodity, and people use it for jewelry and fillings, and actually there's a lot of new technological applications for both gold and silver that are changing the sort of supply and demand mechanics of them as commodities. But we think of them as financial assets, and we encourage other people to as well, because at the end of the day, that's what will drive them going forward. That, of course, is not the case with copper, zinc, and lead, and so on. So if the kind of economic turmoil and fallout from government policy worldwide is what we think it will be, which is negative, we're very bearish on the global economy, that's obviously not good for base metals and industrial minerals, but very good for precious metals. It's important to keep in mind. As for the near term, everybody wants to know, what happens next? Well, the shorter the term, the harder to give a meaningful answer, of course. So I don't have a crystal ball. I don't want to pretend to know anything that I don't. That's really quite silly. That said, gold has risen so much, so quickly this year, that a little bit of pullback seems reasonable, a little consolidation, and we've seen a little bit of that this week already, a little sideways trading. Some of my technical friends like to point to the, say, 1350 to 1360 level as a resistance barrier, and that gold may bounce off that and pull back for a while, but if it breaks through, it may go on up significantly higher. So which way will it go? I certainly can't tell you, but I do think it's worth being cautious in the very near term, because gold has had a very spectacular run so far this year, and it is normal, if something sort of goes above its trading range for a little pullback. And I would view that as an opportunity, of course, because longer term, the fundamentals we've been discussing will push gold much, much higher.
I think a new factor when it comes to precious metals is that now with new technology, palladium can replace most of the platinum used in catalytic converters. Before, I think the ratio was 2-to-1.
Yes, there's been a notable improvement in that, and there is an issue with high temperature applications. Platinum's still better for that. So for diesel motors, that's an issue. Diesel motors are more common in Europe. Europe is not the fastest growing economy area in the world these days, so that's less of a factor. Asia, though, they use mostly gas-powered engines. China, for example, has gone down the path of tightening environmental standards, so they're requiring catalytic converters to be put in their cars now, and that's all palladium. So there's a lot of demand baked in the cake, industrial demand for palladium. We like it a lot on that basis, but also platinum and palladium are precious metals as well. So they're kind of an interesting hybrid, a way to play a little bit of both. We're actually quite bullish on platinum and palladium, mostly palladium, but both. And I hate to say it because I don't want to sound like a Schadenfreude fan here, but the troubles in South Africa are very significant in terms of the future pricing of these metals. And it's unfortunate, but it is what it is, and it's not good. Just look at the Amplats force majeure declaration today. These sorts of things are ongoing. They're going to get worse. So there's supply issues there, and there's demand issues there that paint a very bullish picture for both, but particularly we think palladium going forward.
What about other metals? I've heard that lithium is going to be going crazy because now Tesla Cars plans to build perhaps what is the biggest lithium battery factory in the world.
Yeah, that was big news, and it's interesting. Actually, we were early in the lithium sphere. We made a recommendation some years ago, right before this whole lithium-ion battery thing became the vogue, and a lot of companies changed over to lithium companies. It's a tricky area, but for the right pick, the right company, I think there is good money to be made there. I'm not so sure this one news item is really quite the game changer some might make it out to be. There are complicating factors. There are new technologies that are being developed that call for much less lithium to be used in these batteries. So, technology gives us on one hand, but it can take us away on the other too. I'm cautious about this. I wouldn't bet the farm on lithium, but it is an interesting play.
Louis, is there a website people can go to research more about what KC Research does and how you can take advantage of the knowledge you guys dig up every second of every day?
Thanks for the opportunity. So, of course, if they go to kcresearch.com, and that's C-A-S-E-Y, like Casey at the bat, kcresearch.com, there's a lot of information there, including a free weekly publication. Actually, it's a free daily publication called our Daily Dispatch. And I supervise the Monday Metals and Mining edition.
And Louis will be doing exclusive reports for TalkDigitalNetwork.com from the Prospectors Development Association of Canada conference in Toronto next week. Louis, what do you expect to be the big news from there?
Well, the PDAC is, of course, the Prospectors and Developers Association, not just a company show, so it's famous for being the place where deals get done. I don't know if I'll be able to have a scoop from the field there, but that's what I'll be looking for. Who's talking to who? Which companies are on the block? What kind of M&A action can we see? That's been heating up so far this year, and I expect a lot more of that now that prices are turning up again. People want to buy before things get expensive.
Thanks to our guests, Rick Rule, John Kaiser, and Louis James. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.